swing. Now, family members and listeners alike, I want you to listen very closely, and I want you to take copious notes. And everything I'm about to give to you, I want you to go back and research it yourself. As we always say in the ASK THE WIZ Wealth Institute, trust but verify. And as you need to know and understand and understand is that nothing under the sun is new. Everything is cyclical. Everything works in a cyclical pattern, meaning that the universe is cyclical and it is interconnected through a circular pattern, and behaviors of humans who inhabit this thing called the earth, which is in the universe, engages in the same behaviors over and over and over again. Now, yours truly did some research as of late. I do that often. And I found that 107 years of history clearly says that His Royal Highness Donald Trump and the United States faces a recession within the next 18 months. I repeat, the United States will face a recession within the next 18 months. Let me give you the empirical evidence to confirm the same. Now, there is strong evidence indicating the United States economy may be 1 or 2 quarters away and 18 months at the longest or the furthest out from a recession. Now, to validate this statement, I call and I present to you the unimpeachable witness of history, crunching 107 years worth of data. It reveals the United States economy enters or is in a recession every single time a two-term president vacates the throne. Let me repeat that. The U.S. economy enters or is in a recession every time a two-term president vacates the White House. Listen to me closely. Since 1910, the U.S. economy is either in recession or enters a recession within 12 months in every single instance at the end of a two-term presidency, effecting a 100% chance of recession for the new president. If I remember correctly, President Obama was a what? Two-term president. Only 2 incoming presidents were not treated to a recession within the first year of office, and both followed one-term presidencies. Not every single election sees a recession. Only every 2-term incumbents change. Only 2 presidents in history did not see a recession, and they were inaugurated after single-term presidents. Now, how, pray tell, do you explain the phenomenon? Maybe it takes 2 terms for presidential mischief to work its way into the economic machinery. I don't know. All I know is what the facts present. One-term presidents just can't heave enough sand in the gears. Regardless of the reason, it leads to one conclusion. It's not a coincidence. Now, His Royal Highness Donald Trump now finds himself 5 months into his 12 months, or his first year of the U.S. presidency. Where does the prediction then stand, beloved? By the grace of the Creator or Janet Yellen or neither or both, no recession as of yet. But as pessimistic thoughts rise, they remind us that 7 months remain, and anxiety riles the deeps and the depths of our being. For we've spotted ill omens, disturbing portents of recession amongst the recent economic data. Now, let me give you the empirical data for you to confirm on your own. Past 5 decades, each time commercial and industrial loan balances at U.S. banks shrank or stalled, a recession was either already in progress or would start soon thereafter. There has been no exception to this since the 1960s. And the last time this happened was during the last financial crisis. Guess what? Now it's happening again. Please note and write this down for your own individual confirmation. Last month, commercial and industrial loans that are outstanding fell to $2.095 trillion, according to the St. Louis Federal Reserve Bank. That's down 4.5% from their November 2016 peak. And it marked the 30th consecutive week of no growth in commercial and industrial loans. Now, you see, commercial and industrial loans matter to those of us that are economists because they directly reflect the real economy. Unlike today's stock market, which is manipulated, and we just went over that, and now they're even manipulating the cryptocurrencies. You see, today's credit flows of commercial and industrial loans have not been this negative for 27 years outside of a recession. And sometimes credit flows turn negative before a recession, and sometimes after. During the 2008 crisis, for example, credit flows didn't veer negative until the economy already entered the recession. But before the shorter recessions of 1990 and 2001, credit flows started falling 3 to 6 quarters before the recession. Overall, though, the relationship between negative credit flows and recessions holds true since 1948. And here's where the needle scratches the wax, if you will. The current decline in the credit impulse started in the third quarter of last year. Thus, the U.S. economy may be just 1 to 2 quarters away from a recession. Now, is the economy just 1 or 2 quarters away from the recession? That would put it within Trump's first year in office and keep the 107-year record perfect and intact. First quarter GDP grew at a slender 1.2% annualized rate. Not recessionary, but growth at a tortoise pace. In March, the New York Fed guessed, that seems to be just the right word to use right here, the New York Fed guessed, or estimated, that second quarter GDP would bloom just under 3%. But last week, it had to downgrade its forecast to a mere 1.9%. And they did that very quietly. Now, I wouldn't be a least bit surprised if they have to downgrade it again. That seems to be the pattern. Now, the economy only expanded 1.6% last year, family members and listeners alike. And since they keep having to revise their forecast lower, would you be surprised if the economy doesn't grow at all this year? Or worse, if it actually enters a recession? Remember, 107 years of history says it will occur, a recession coming soon. Take the information and research it on your own. Now, I've got some more information, to give to you. I'm sounding the trumpet, and this evening, during our ASK THE WIZ Wealth Institute, beginning investors and traders webinar, yours truly will be going over how we're going to not only survive, but we're going to thrive during the upcoming recessionary period. Got some powerful information to give you from 8 until 9:30 p.m. Eastern Standard Time. That's tonight, June 22nd, 2017. The ASK THE WIZ Wealth Institute Beginner Traders and Investors webinar. Now, the conventional definition of gross domestic product, or GDP, has 4 main components. Write these down. Those main components are consumption, investment, government spending, and net imports. These are the things that make up the gross domestic product. Once again, consumption, investment, government spending, and net imports. Now, consumption is almost 70% of the total economy. In the most recent quarterly report from the Commerce Department, total annualized GDP was $19 trillion and consumption was $13 trillion, or 68%. The impact of consumption does not stop there. Listen to me. You see, if consumption slows down, investments tend to slow down as well. Businesses will not invest in buildings and heavy equipment unless the customers are there to purchase the output needed to justify those investments in the first place. So very simply put, when the consumer catches a cold, the entire economy gets pneumonia. Now, something like that appears to be happening right now, and it ties into the 107-year history of recession cycles. Retail sales, family members and listeners alike, are down sharply due to a combination of weak wage growth, income inequality, okay, and deflationary expectations. And meanwhile, consumer confidence has fallen to the lowest level since November of 2016, and consumer spending fell in May. Inflation was also lower in May. And then on top of all of this, the Fed is creating headwinds with rate hikes and by reducing the money supply through its new program of quantitative tightening, or QT, which is the exact opposite of quantitative easing, or QE. Now, with stock market indices hitting new all-time highs almost daily and the economy hitting stall speed, a severe stock market correction is in the cards. It has to happen. Now, how did we get here? Well, in the past 7 years, major central banks have created over $15 trillion of new fiat money, money not backed by gold, mostly through purchases of government bonds. Now, these money printing and bond purchasing programs have been called QE1, QE2, and QE3 in the United States, and then the Euro QE in Europe, and the QQE, the quantitative and qualitative easing, in Japan. Now, all of these programs and exotic variations such as Operation Twist have failed to achieve self-sustaining growth anywhere near former trends and have failed to achieve the 2% inflation targets of those central banks. Now, we have not had much consumer price inflation, but we have had huge asset price inflation. The printed money has to go somewhere. And instead of chasing goods, investors have been chasing yield. But the stock market and the bond market are sending two different messages. Listen to me. You see, the Dow is already traded above 21,000, okay, for the first time ever. And the S&P broke out to new highs less than 3 days after last week's Wednesday's rate hike by the Federal Reserve. Meanwhile, the NASDAQ continues to move to the upside with a record run. Stocks seem to break records every other day as of late. Now, if the Fed's hiking rates to slow down the train, it's not working. The train is speeding up. But the bond market, now this is the conundrum, family members and listeners alike. The bond market is telling a completely different story. The 10-year Treasury bond, its yield has fallen from 2.4% in mid-May to 2.16% today. Now, falling yields suggest weakening growth or possibly recessionary activities on the horizon. The opposite of what the stock market is saying, because the stock market is continuing to reach new highs. So, if bond yields are falling because deflation is ruining the Fed's plans to reflate the economy, is that a reason for stocks to go up? If bond yields are signaling recession, should you really be bidding up stock prices to extreme levels based on the theory of yield parity? You see, that behavior defies common sense, which is not common, and economic history. I'm talking about 170 years worth of it. But it's exactly what we're seeing in the markets today. You see, at some point, probably sooner than later, the reality of central bank impotence and looming recession will sink in and stock valuations will collapse. The drop, family members and listeners alike, will be violent. 401ks and retirement plans are going to lose massive amounts of capital. Some analysts predict perhaps 30% or more in a few months. So, you don't want to be over allocated to stocks when this happens. The analysts, okay, that are cognizant of this, the economists who are being honest and they're actually seeing what is being set up to occur, okay, they realize that this situation doesn't apply just to stocks. It applies to a long list of risky assets, including residential real estate, commercial real estate, emerging market securities, junk bonds, and more. You see, family members, don't ever forget this. It only takes a crash in one market to spread contagion to all of the other market asset classes. Don't ever forget that. Trouble travels quickly. Now, the last two global illiquidity, panics, where people were running to try to go ahead and get liquid with their capital, that call in 1998, that was caused by emerging market currencies. We're talking about Russia, and then long-term capital management that was non-existent. And then in 2008, it was caused by the subprime mortgage debacle and Lehman Brothers and AIG. Okay? Now, at the end of the day, we've got to be cognizant of what is actually going on. And just because nobody talks about it, that doesn't necessarily mean it's not occurring. And if you think back, another smaller liquidity panic arose in 2010 due to the problems in the Middle Eastern and European sovereign debt situation caused by Dubai, Greece, Cyprus, and the countries in the European periphery. Now, in all three cases, central bank money printing combined with government and IMF bailouts were enough to restore calm, or shall we say, a false sense of calm. But these bailouts came at a high cost. You see, central banks have little room to cut rates or print money in a future crisis. Even the Fed, even with the Fed recent rate hikes, they're just off of 0%. That's why the Fed is so determined to raise rates so it can cut them again when it needs to. Now, of course, by raising rates into a weakening economy, the Fed could be creating the very crisis it's trying to avoid. The strategy might sound nuts, but that's how they think, and that's what they're positioning themselves to do. And meanwhile, taxpayers are in full revolt against more bailouts, and governments around the world are experiencing political polarization. There is simply no way, for this situation to continue as it is, and the next panic or recession will be disastrous when it hits. I didn't say if it hits, I said when it hits. You see, with central banks around the world doing everything possible to cause inflation, I'm talking about quantitative easing, helicopter money, currency wars, forward guidance, etc., what does it say about confidence in central banks that inflation expectations are falling and not rising? The systematic dangers are indeed clear. You see, the world is moving towards a sovereign debt crisis because of too much debt and not enough growth. Declining productivity is the last nail in the coffin in terms of countries' ability to deal with the debt. Now, inflation would help diminish the real value of the debt, yes, but central banks have proved impotent at generating inflation. So now central banks face the prospect of recession and more deflation with few policy options to fight it. You see, persistent low rates have caused inflation, but they have caused asset bubbles. And I need to rephrase that. Persistent low rates have not caused the inflation that the Fed banks want or the central banks want. But they have, caused asset bubbles, which threaten to pop and unleash a financial panic on their very own, independent of tight financial conditions. Now, when this new panic hits, either from a liquidity shortage or bursting asset bubbles, traders and investors will have no confidence in the ability of central banks to limit the panic. And unlike 1998 and 2008, the next panic will be unstoppable without extreme measures, including IMF money printing, lockdowns of central banks and money market funds, and possible martial law in response to money riots. Now, we talked about what I'm about to say a little bit yesterday in our Ask the Wiz virtual trading room. One sign that investors sense a coming crisis is that the demand for secure vaulting space in major financial centers like London and Frankfurt is soaring. There are plenty of bank safe deposit boxes in those cities, but savvy investors, the uber wealthy and the like, are insisting on non-bank vaults because they understand that the banks cannot be trusted in a panic. They just negate access to their depositors' money. Now, as a result, proprietors of non-bank vaults can't build them fast enough. You see, this is one indicator that reveals three important facts. Listen to me. The first is that traders and investors feel a panic may be near and the time to act is now. The second is that traders and investors don't trust banks. And the third is that traders and investors are buying the shiny yellow metal gold to protect themselves, since that's the main tangible asset that people put in their private vaults. And then next is cash. So you'd be well advised. Don't you wait until the panic hits to secure some of your gold or your shiny yellow metal positions. Family members, I bring your attention, I'm talking about ASK the WIZ Wealth Institute family members, to the list of over 40 gold-related positions. You've got junior miners, you got major miners, you got macro ETF gold-related positions, and you got stock-related positions, gold-related positions, to get you PAIDs submitted to you by yours truly. You need to start looking at those now. And you need to be looking at these in the investment portion of your portfolio. You invest long-term, you trade short-term. You should never, however, go all in on any one asset class, including the shiny yellow metal gold, which is why I recommend putting only about 10% of your investable assets in gold. But you want to own some shiny yellow metal soon, and very soon, before the next crisis strikes. It could be here much faster than you think. Family members, don't you tarry on that information. And for those of you that aren't recording this last ASK the WIZ Wealth Institute Classroom Walls radio broadcast, like always, it will be on demand on our website at www.askthewiz.info. That's www.askthewiz.info on our homepage. And all you have to do is click on it, and you can hear it once again in its entirety. Time to rise up, family members. Time to do for self. Time for us to see now what others see eventually. When we come back, going to give you three